Hello, this is Lara with your end of the week video for US oil for the trading week ending Friday 8th of May. I am still expecting that oil has found a major sustainable low quite close to that target, which was at 9.77. It was just 0.5 off that target, and I'd held that target for months, and I'd had a main bearish wave count for a long time. Oil may have found a sustainable low, and technical analysis supports that view. We can have further confidence in that view if a new high above 29.14 is seen and price is pretty close to that point. Elliott Wave analysis first, classic analysis last. The classic technical analysis supports this Elliott Wave count, which expects a sustainable low has been found for oil. This structure, in Elliott Wave terms, is a corrective structure. The basic Elliott Wave pattern has 5 steps forward followed by 3 steps back, and this big bear market for oil is seen as a 3-step back pattern. The Elliott Wave structure is a double zigzag. Here's the first zigzag in the double, labelled cycle W. The double is joined by a 3 in the opposite direction, labelled cycle X, and here's the second zigzag in the double, labelled cycle Y. Double zigzags are fairly common structures. But before I go on to the next chart, one of the biggest mistakes I see online in work calling itself Elliott Wave is labelling these structures wrong. When you see a multiple labelled within a multiple, don't waste any further time on that analysis because it's breaking one of the Elliott Wave rules and doesn't understand multiple corrections. If you see W, Y, or if there is one labelled within them, W, X, Y, X, Z, the rule broken is the maximum number of corrective structures within a multiple is 3. If you label multiples within multiples, you're increasing that maximum beyond 3 and violating the Elliott Wave rule. And when I see work that does this, it's usually labeling impulses or multiples wrong. It's usually labeling impulses wrong, and it seems to be fitting W, X, Y, X, Z where it shouldn't be fitting, in order to see a movement which the analyst doesn't understand and can't fit into Elliott Wave rules. So W, Y, and if there is one, should themselves only be labelled simple corrective structures, A, B, C, or in the case of a triangle, A, B, C, D, E. This double zigzag is likely complete here. There's not a lot of room for oil to fall into any further. Double zigzags are fairly common structures, but triples are fairly rare. So the only way this structure could continue lower would be as a fairly rare triple zigzag. And because there's very little room for oil to move into, the probability of this movement being over is very high. A new high above this price point would add strong confidence to the Elliott Wave analysis. If this is a second wave correction, then it should be over here, and a third wave at supercycle degree for oil may have begun here. Let's take a look at how the second zigzag in the double unfolded, where X, the cycle wave X, is this point up here. Cycle Y subdivides as a zigzag, 5, 3, 5. Within it, primary wave B is a double combination, a zigzag for intermediate W, X joins the two structures in the double in the opposite direction, and itself is subdividing as a simple zigzag, which is the most common structure for an X wave, and wave Y subdivides as a flat correction, 3, 3, 5, meeting all rules for a flat correction. And the whole structure takes up time and moves price sideways. And primary B, taking so long, gives cycle wave Y zigzag a really obvious 3-wave look to it. There are a couple of really bullish long lower wicks here, a couple of hammer candlestick patterns at this low, which ended at 10.24. If this is the end of a second wave correction, then a third wave up may just be beginning. We can have some further confidence in this view with a new high above the confidence point. At the daily chart level, here's the end of primary B and the end of primary C is a 5-wave structure and the start of a new upward trend. Within the new upward trend, no second wave correction may move beyond its start below 10.24. Along the way up, there will be corrections and consolidations along the way because markets don't move in straight lines. They have counter-trend movements within them. Look out for particularly intermediate wave 2, and when we get there, primary wave 2 to possibly be very deep and time consuming, because this particular market early on in a new trend does tend to start out reasonably slowly. It accelerates through the middle and explodes at the end. That's typical commodity behaviour. Its second wave corrections, in terms of Elliott wave, its second wave corrections can be very deep and time consuming compared to the first waves that they correct. So when we get to it, I'll expect intermediate 2 to be deep and time consuming, and further on, many months away, I'll expect primary 2 also to be fairly deep and time consuming. For the very short term, minor wave 2 may also be deep and time consuming. Basing action over many months at the beginning of a new trend would be normal behaviour for this market. So although these labels are all sitting along this straight line, don't expect price to move in a straight line with only brief shallow corrections along the way. This is indicative of the Elliott wave count, not of the absolute direction for price within this. It's going to be choppy and overlapping, particularly at the start. At the monthly chart level, I'm trying to consider all possibilities. And I've received some backlash for this chart and the view that it's trying to outline. And I would like to, I'd like to consider my analysis in the spirit of always considering all possibilities. I'm not going to have a stance which says this is what the market must do. I'll never say that. And I'll also never say this is something the market can't do. If anyone had told you that oil would reach deep into negative figures, that would have been received with a lot of derision. That's not what my target said, and oil ended up finding this low with this data anyway, pretty close to where I had the target. But I did receive some backlash and some derision for a very, very bearish wave count for oil back here, and now I'm receiving some backlash and derision, which I find somewhat amusing for this chart. But I am going to consider all possibilities. We can't tell the market that it can't simply end around about these lows and simply move sideways, because we've seen precedent for that before. And as soon as you try and tell a market that it can't do something, it's probably going to prove you wrong anyway. This wave count, or this chart, considers the possibility that the market for oil may simply cease to exist, just like the market for tulips ceased to exist pretty much after 1637. The tulip market had a major bubble, and the bubble burst, and those bubble prices were never seen again. The price for tulips does exist, but it's remained relatively reasonable and relatively low ever since, and tulips never formed another price bubble. It's possible that oil may never form another price bubble, that it may never retain these highs back up here. And the other reason why I'm going to consider this is I want to use Elliott wave analysis to tell me when to discard this idea. I had an alternate daily chart which would be invalidated with a new high above this point. That alternate chart was bearish. And so if we see a new high above this invalidation point, I will then discard this idea based upon a particularly low probability. If we see a new high above this point, this idea would be absolutely discarded based upon an extremely low probability and price proving it wrong. I want to wait for the market to prove this wrong, not detractors' comments to tell me I shouldn't be considering all possibilities. Moving on. At the weekly chart level, there is evidence of a sustainable low in place for oil with two hammer candlestick patterns. These are bullish reversal patterns. We've got two in a row with particularly long lower wicks. A selling climax with this week. ADX reached extreme for the downward trend, and RSI reached deeply into oversold and then exhibited bullish divergence. So with all of that combined at these lows, it does look quite strongly like there is a sustainable low for oil in place. For the very short term though, for this week, a nice strong upward week comes with quite weak volume. And this is concerning for upward movement, and it's telling us that the risk for a pullback here is probably fairly high. Again, don't expect markets to move in straight lines. There will be counter-trend movements along the way. On balance, volume gave us a bearish signal back here. This week it's broken back above this support and resistance line, negating that bearish signal. And so on balance, volume is not bearish. Benova RSI stochastics showed the same thing. At the daily chart level, there's a gap here. This, at this stage, may be labelled a measuring gap, but this sideways movement gives some cause for concern over a target calculated from the gap. A target calculated from the rise up into the gap from this low to this high and added to the lower end of the gap gives us a target 34.73. That may not be met though, because if that's going to be met, price should be moving up toward the target, not moving sideways. The lower edge of this gap is at 21.42. If it's a measuring gap, it should offer support until the target's reached. If 21.42 is breached prior to that target being reached, the gap would then be considered closed and it would be relabeled an exhaustion gap. If that happens, look out for downward movement to continue for a pullback. Look for initial support here and next support down here at this swing low. Volume is not supporting upward movement. There's a little bit more pressure for downward movement in recent days than there is for upward movement. The risk of a pullback here is quite high. ADX is declining after reaching very extreme for the previous downward trend. That's pretty normal for oil. It tells us there may be a potential trend change, but not yet a new upward trend as a lagging indicator. It's based on here on a 14-day average. ATR was increasing as price was falling. It's now declining to flat as price is rising. Again, a little bit of weakness in upward movement. The risk here of a pullback is quite high. On balance, volume is constrained. A breakout would provide a signal. It hasn't broken out yet. The signal would be weak though, because the resistance line is weak. It only has the minimum required 2 anchor points to draw a line. The support line only has 3 tests. RSI is in neutral territory after being deeply oversold and exhibiting triple bullish divergence at the daily chart level. There's again room for price to fall, and there's also still room for price to rise, and stochastics overbought. That's all from me this week with your oil analysis. I hope all our members are staying safe and staying healthy.